In the unconventional space, these wells are getting longer in the tooth, right? They're getting more mature. We're still educating our customers on the best way to forecast these wells. So it's kind of a tricky game. If you do a best fit decline through, you get your production history and it's coming down. If you just fit that production history with a best fit equation of line, it's going to overstate reserves, but it looks perfect,
It
right?
looks
It looks
great.
perfect in the data room environment. That's what all the sellers are doing. They're just looking, it's the best fit. It's the best fit. And we know that those curves change over the course of their lives as the well begins to experience interference from various stages or offset wells.
Welcome to An Ounce of Prevention, the podcast. At our recent associates, we believe that an ounce of prevention is worth a pound of cure. Our daily commitment lies in informing our clients about legal risks without hindering their business objectives. As we like to say, we're in the business of building companies and helping executives sleep at night. So stay tuned. Maybe you'll learn something that'll help your business grow and thrive.
Welcome to An Ounce of Prevention, where we believe an ounce of prevention is worth a pound of cure. I'm your host, Rachel Reese. Before I introduce my guest, let's take a quick look at a recent case law update and break down what it means for your business. The next case covers Clarke versus you, a contract dispute over an oral and implied joint venture agreement arising out of San Diego, California. Let's dive in. Clarke is a venture capitalist who previously worked with you, a chemistry chair and professor at the Scripps Research Institute, to fund and form biomedical research companies. In December 2021, Clarke contacted you about the possibility of creating a new company together. In response, you sought renewable funding to develop a new generation of technologies focused on carbon-hydrogen activation, commonly known as CH technology. Clarke and you named the potential company Change Pharma, Inc. However, 6 months later, you emailed to thank Clarke for his interest and efforts, but expressed his desire to explore other investors, as Clarke's proposed business and financial plan would not be sufficient for Change. Clarke then sued you, asserting claims for breach of an oral joint venture agreement, breach of an implied joint venture agreement, and quantum merit. You moved for summary judgment, and the trial court granted the motion. Clarke appealed. On appeal, the court decided whether the statute of frauds barred Clarke's claims for breach of an oral or implied joint venture agreement. Clarke argued that the statute of frauds did not bar his claims, while you argued it did. A joint venture involves an agreement with a commercial objective under which the parties have 1. A joint interest in a common business, 2. An understanding to share profits and losses, and 3. A right of joint control. However, any agreement that is not performed within a year from the agreement's making is subject to the statute of frauds. So, for any joint venture that will take longer than a year, the statute of frauds requires the agreement to be in writing. The court held in favor of you and upheld the trial court's grant of summary judgment. The court explained that there is no case in California law that exempted the statute of frauds from an oral or implied joint venture that, by its nature, could not be performed within a year. Further, both parties, through evidence and witnesses, agreed that developing the CH technology would take longer than a year, possibly multiple years. Commercializing the technology would take even longer. Because the potential joint venture would take longer than a year, the statute of frauds was triggered, and the alleged joint venture agreement needed to be in writing. The court concluded that because Clarke and you never formalized a written agreement to develop Change Pharma, such as a contract, the statute of frauds barred Clarke's claims for breach of the joint venture. The court then moved on to the next issue, Clarke's quantum merit claim against you. Quantum merit refers to the principle that the law implies a promise to pay for services. If a plaintiff justifiably relied on the belief that the defendant would pay for the requested performance, the plaintiff could recover his pay. However, this rule only applies if the services were rendered at the request of the person to be charged. Clarke argued that under quantum merit, he expected to be compensated for services he performed for you, such as securing a patent lawyer, preparing detailed business and technical plans, arranging meetings and travel, and finding other business partners. However, you never requested these services, and Clarke expected to be compensated by acquiring an interest in Change rather than by a cash payment from you, dooming Clarke's quantum merit claim. Overall, the court affirmed the trial court's grant of summary judgment against Clarke. So why does this matter? Emailing ideas or plans with a potential business partner is not sufficient. If you want to go into business with someone, you need to ensure that your business agreement is in writing to ensure that the agreement is legal in case future disputes arise. Our RNA advises on joint venture agreements and other business partnerships, ensuring you and your business partner enter into business together with confidence. That's all for today. I'd like to thank Frances Warden from our Denver office for her help with this update. Thad Toups is president of Haas Cobb and a licensed professional engineer with decades of experience in petroleum engineering. He's actively evolved across the firm, working closely with engineers, geologists, and clients to deliver clear, accurate evaluations. Known for his practical approach and high standards, Thad focuses on getting the details right and providing work clients can rely on. He's also one of my favorite people to get a beer with. Welcome to the podcast, Thad.
Thanks, Rachel. Good to be here.
We're going to talk today about all things third-party engineering.
That's what we do. Yeah, we're third party. Which means we don't own any oil, we don't own any gas, we don't have any stake in your companies. We don't work for a contingency-based fee, success fees or anything like that. So we're truly independent of our customers, which gives us a place to, provide an unbiased opinion of reserves and value.
Well, you told us what you don't do. Tell us what Haas and Cobb does.
Your audience may be familiar with Haas Engineering or Cobb and Associates. These were two mid-sized consulting firms, petroleum engineering and geologic consultancies that were in Dallas, and we merged those two companies together a couple years ago. It's been a great marriage. On the Haas engineering side, we were largely focused on unconventional reservoir engineering. So we had a lot of customers in the shale plays. On the Cobb side, those guys were much more focused on conventional assets and water floods and CO2 recovery. So it was a great marriage, bringing together kind of both sides of that. And we really feel like we can engineer anything that comes through the door. But yes, we are an engineering and geologic consultancy.
I actually didn't know that split before today. That makes a lot of sense.
Yeah, the Cobb side, I'm real excited about it. So I grew up on the Haas side, mostly unconventional in my career, and the Cobb guys literally, wrote this book on water flooding. So getting to experience, 25 years into my career here, getting to experience some new kinds of projects, which is always fun to learn new things.
Yeah. Well, what's the latest in water flooding and conventional wells?
The last stat I heard on this front was, in the shale plays and the unconventionals, something like 70 or 80% of the remaining undeveloped locations are controlled by large public companies. Small, mid-size, even large companies are getting squeezed out of tier 1, tier 2 rock in these shale plays. So there's been a refocus back to conventional assets and back to water flooding, where it's an old technique that's proven to, sometimes double or even triple the amount of oil you can get out of an old mature field. So we're getting lots of inbounds about, hey, can you refresh us on water flooding? Do you think this would be a good field for that? Let's do a little case study. And so we're seeing a lot of our customers kind of coming back to that conventional space.
Yeah, but when you're doing something like water flooding or EOR, there's actually a lot of work that goes into it before you can put the water in the ground, like unitization, for example.
Yeah, typically what you'll do is, if you get neighbors, you'll pull your tracks together and form a unit. And there's a process that goes to the Railroad Commission if you're in Texas that, kind of requires, this is how we're going to split the baby, right? This is how we're going to share the revenues that come out of this, because we may be injecting more water and producing more oil over here, but it's because my unit has the water that's pushing it. So you kind of want to do it fairly. And we do quite a bit of that work at the commission when folks need that support. We support on the regulation side of things.
So back to unconventional, what are you guys doing over there?
In the unconventional space, these wells are getting longer in the tooth, right? They're getting more mature. We're still educating our customers on the best way to forecast these wells. So it's kind of a tricky game. If you do a best fit decline through, you get your production history and it's coming down. If you just fit that production history with a best fit equation of line, it's going to overstate reserves, but it looks perfect.
It looks great.
Perfect in a data room environment. That's what all the sellers are doing. They're just, look, it's a best fit. It's a best fit. And we know that those curves change over the course of their lives as the well begins to experience interference from various stages or offset wells. So that's the main I guess point that we're hammering home on the unconventionals is don't do a best fit line through the entire production history because you will overstate reserves.
Well, that's especially important if you're a buyer, right?
Yeah, and it can be in the order of 20 or 30% too high. But again, in the seller's perspective, it looks exactly right. The buyer may look at it how I'd do it too, and you might end up being 20% too high.
Darn third-party engineering firms coming out at us with facts.
Just trying to protect our investors, The fair market value of an asset is, given all the facts, what a buyer and a seller can agree upon. So we just want to arm our buyers with all the facts.
Talk to me about your expert witness work. I've always found that part really interesting.
We offer that service. We've got 3 or 4 guys over here that do quite a bit of it. Most of the cases that we're seeing these days involve water, right? So the Permian Basin, for example, makes more water than it makes oil. And so there's got to be a place for that to go. And, typically there's shallower zones kind of above the Bone Springs that folks are disposing into. There's deeper zones below all the target formations, but that was causing some seismicity, when they were injecting the water down there. And so in these shallow zones, now we're seeing, though, it's affecting the wells. It's breaking through the rock and impacting some of these producing wells. So most of the expert witness stuff we're seeing come through these days is centered around disposal water causing damages to producing wells.
So you're saying my well's producing just fine, and then all of a sudden I'm producing only water, and I look around and find that there's an injection well fairly close to me that should have been, much shallower than everybody thought it was, and now it's broken into my well?
Right. Not necessarily the depths were wrong, but, maybe they were injecting at a higher rate than they were approved for, or they noticed there was breakthrough and kept injecting anyway. There's various angles that come out of these cases, but that's a big problem that we're going to have in the Permian, but we'll figure out how to solve it.
Yeah. And that's just in Texas though, right? Because New Mexico isn't allowing us to dispose of water anymore.
Correct. And that's put a bigger burden on Texas. New Mexico won't allow, I believe, injection disposal into the shallower zone.
Right.
So, they're trucking it across the state line and just doing it in Texas. And yeah, we literally have had some customers where they drill a pad of wells, 4 or 5 of them in a bench and kick them on, and it's all water. And it's like that doesn't happen in these benches unless there is something external like a disposal that's gone bad.
Let's talk about some other things that are going on lately in this space. Talk to me about the PCAOB.
The PCAOB is the Public Company Accounting Oversight Board. This is the governing body that sort of sits on top of and regulates the auditing firms, the KPMGs, the Baker Tillys, the Weavers, so kind of oversight over there. And they're giving direction to these auditing firms that they need to be doing more technical due diligence. They're relying too much on external engineering. They're to say it another way, they're not asking enough questions about the assumptions that go into the values of these companies and these assets. So
the companies are giving the engineering to the auditing firms. And now the PCAOB is saying you need to be asking more questions about this engineering that you got.
The way it works is we'll do an annual report, an SEC reserve report for a public company. The auditing firm is the one that actually sort of certifies that and posts it to the 10K for the company. And they're the ones that are kind of on the hook for stating the reserves, right? But our reports, obviously what they're relying upon, and the PCAOB is asking more questions of the auditing firms to make sure they're doing more technical due diligence on what we're providing. We being the third-party engineering groups. We've been on both sides of it already. We've got a report out there, and there's a auditing firm with the technical expert asking us questions about the assumptions and the material assumptions. We've been on the side where we're getting somebody else's report and doing the same kind of question and answer session, but there's more rigor coming down on public traded companies.
Is it changing how you're doing your reporting for these public companies?
No, proved reserves should be proved reserves, right? It's a defined confidence level. The main job of us a reserve auditor like myself is to define that confidence that we have in these numbers. So if I give you an estimate of reserves without any sort of context of am I 50% confident that we'll meet that, or am I 90% confident we'll meet that? If I give you a number without a confidence interval, it's kind of a worthless number. So it's just our jobs in these reports to put those confidence intervals in appropriately, so it's clear to the reader what we mean by the reserves. So it hasn't changed our practices. I just think there's been more scrutiny on, is this really are you really 90% confident in these proved reserves? So they're asking some more questions, more support.
So what is the percent confidence that you have to be to call it proved?
90%. So, again, it's a very conservative number when you think about it. And, that means 9 out of 10 years, I should be the same or increasing the reserves for this company. So a very conservative number. Like I said, in the A&D space, we wear a few different hats, right? We're putting 90% confident reserves in SEC reserve reports. But in the A&D space, if you're trying to buy assets and you're using a proved number where you're 90% sure that's what it's going to make, you're not going to win many deals, right? So you're looking for more of a business case in those settings where you're doing more of a P50 or likely or not estimate there, which is, again, more in line with how you run your business, right? We can't run our business being 90% confident if we're deal makers. So again, just making sure our customer knows our confidence interval on this and it's being used appropriately.
So when you say P50, you mean you're 50% certain?
Yes, or 50% chance it's higher than this, 50% chance it's lower than that. So kind of down the fairway there. And that's, again, that's typically what folks will transact around, kind of a P50 answer. But then when you buy those assets, right, you get your P50 answer. Now you want to put them in your year-end reserve report, or you want to put them in your bank loan that requires the reserves to be approved. That's going to be a little different number, right? It's going to be a little more conservative estimate of reserves.
What's the confidence level for bank reports?
Also approved. The bank does not want to lose any money. They want a 90% confidence that their loan is safe. Things are out of our control, like commodity prices, but they want to know that the reserves are pretty much a certainty. And in fact, the SEC, to define this a little bit more, proved reserves according to the SPE is a 90% confidence number. The SEC actually says reasonable certainty. So it's a slam dunk case, and that's the only kind of reserves that the bank wants to loan against. When you're talking about senior debt facilities, there's other, mezz groups and secondary financing groups that will look at probable reserves, which is what we call the reserves that are 50% confident. But that money's going to cost you more. If you want the cheap money, they want it to be a slam dunk, 90% confident.
I mean, I wouldn't call debt these days cheap, but
the cheapest,
cheaper. Yeah. Okay, so you've been working on some other interesting things lately, like international clients, but also international reservoirs.
Yeah.
Why don't we talk a little bit about Argentina?
I've been traveling a lot lately. Did the Vegas trip last week. Week before that, I was in Argentina. There's the Vaca Muerta shale play down there is really booming, and
dead cows.
The government's that's the dead cow, the Vaca Muerta. I think it's the name of the mountain range there, but it's a state-owned situation. So YPF owns the country owns the minerals, but they're trying to get private, other investors into it to exploit it. So Argentina hasn't had the greatest history. I think they've defaulted on their debt 5 to 10 times in the last 100 years, but they've tried to structure it where it is a safer place for, American companies or others to invest in their play, like locking in the tax rate so that you don't get big surprise taxes or anything associated with it. So they're trying to structure that. We're starting to see some deal flow. Like I said, I was there for a conference there for a couple of days, and just being there, I'm starting to get some of those folks saying, hey, do you have any clients that might be interested in this? And it's an opportunity to drill 20 or 30 wells in the Vaca Muerta, which, by the way, are being touted as twice as much recovery of oil as in the Permian Basin. So, they're talking about 900,000 to 1 million barrel wells out there when, your Permian Basin may be half that. Again, haven't verified all those estimates yet.
You wouldn't call that approved?
I haven't screened those deals yet, but we're starting to see some of the deal flow come across. And yeah, well, if it makes sense for any of our clients to if it's comparable or better than what we can kind of get over here in the States, like I said, with most of this tier one stuff being locked up by large publics, international investment, and it makes sense.
Yeah. I mean, if you got capital to spend, you got to spend it somewhere.
Yeah.
Well, it's a good thing you and I know a little bit of Spanish.
Un poquito, I don't even know if I said that right, but I know more French than Spanish. Growing up in Louisiana, we did not learn Spanish in high school. We learned French.
Well, they're not going to be drilling any shale wells in France anytime soon.
No, they actually, one of our founders, Mr. Haas, went over to Paris to try to convince them with some customers. This is a decade and a half ago, but try to convince them that they had shales there that they could exploit, but no fracking, no fracking. We were actually in the UK too. The UK's got millions of acres of shale, and they started down that path 7-8 years ago and had some seismicity issues, and the government just shut the whole thing down. So again, there's a lot more out there if we can get past the frack bans in some of these international plays.
Okay, well, probably about to wrap up here. Do you have any final thoughts for our audience?
I love my job. I get to support a bunch of different kind of clients, from the operator to the working interest owner to the mineral owner to the banks and the midstream. So I love that about my job. We get to jump in and support all different kinds of clients. Most of our work is project work, which gives me that sort of sense of accomplishment after we finish the project. So, if there's anybody out there listening that, we're also growing the team. If there's anybody out there listening that may be interested in being an engineer with us or a geologist with us, please let me know.
Awesome. Well, thanks for being here today.
Thanks, Rachel. Great job. Keep up the good work.
The information and material in this episode is general information about our practice and firm and is for educational and informational purposes only. This information does not offer specific legal advice, and the use of this information does not create an attorney-client relationship with RRNA or any of its attorneys. The information in this episode, or any episode of An Ounce of Prevention, should not be considered legal advice, and persons should not act upon this information without first engaging professional legal counsel.
Thank you for listening to An Ounce of Prevention, presented by R. Reese & Associates. If you found this episode informative, subscribe to, rate, and review our podcast on Spotify, Apple Podcasts, YouTube, or wherever you listen to stay up to date with future episodes, case law updates, and breaking news. If you have any questions or are interested in learning what RRNA's outsourced legal department can do for your company, reach out to us at podcast@rreeselaw.com. That's podcast@rreeselaw.com. Follow us on LinkedIn or call 832-831-2289.